it's a very bumpy roller coaster, but the roller coaster is headed down. But here in January, we think things could get a little better. We really don't see a recession until the back half of 2023. We think the first half is actually going to be muddling along. It's a slow dance into a recession, which is not unusual. That was the case in 2000, 2001. But we are moving into a recession, but it's just highly debated. People are too focused on '08 and 2020. This is more like 73, really? 74, and 20 and 2021.
A slow dance into a recession from Piper Sandler's chief global economist, Nancy Lazare. She joined me yesterday on this program with predictions on a recession in the back half of 2023. Personal spending slipped 0.2% in December, while personal income rose 0.2%. Joining me right now with his thoughts is the former U.S. president and CEO of Walmart, WSS Venture Holdings president and KKR senior advisor. Bill Simon is with us. Bill, it's great to see you. Welcome back to the program.
Good morning.
We've been looking at so many metrics, including the fact that the savings rate has gone up in the last 6 months. We're now looking at a savings rate of 3.25%. Bill, how would you assess the consumer today?
Well, Maria, I think the consumer had been remarkably resilient through, the COVID adventure and the recovery. I think we're now into the second year of pretty substantial inflation, primarily in food, and for them, gas prices, and that's really starting to wear on them. I think maybe they're starting to bunker down a little bit, as you see from the savings rate increase, and we'll see what happens here. I really think the most important thing that the Fed needs to focus on is just getting this inflation under control.
Well, you make such a great point in terms of what we've seen from the impact of inflation. Do you agree with what you heard from Nancy Lazare, that the second half of this year will likely be a recession and will muddle along until that second half?
I think a lot of it depends. We've never really had a full employment recession in this country. We really got to start seeing jobs shed for me to start thinking that there's going to be a recession beyond maybe a modest dip. I think, we're sort of in this loop, Maria, where inflation, primarily food and fuel inflation, is really putting pressure on wages. And now you see wage increases. Walmart announced this week 17% increase in their starting rate. Delta pilots are up 25%. The rail workers got a 25% increase. So all this wage, as a response to the inflationary pressures, actually causes more demand and increase on inflation. And so there's these counterbalancing points, and I think it's going to be interesting to see what happens this year, how strong the consumer remains is both a good and a bad thing for the economy headed into the first half of the year.
Well, I find it really stunning that food has been so resiliently high in price. We're seeing some alleviation when it comes to energy. We're seeing some alleviation elsewhere in services, but when you look at actual rent and when you look at food, like, a dozen eggs up 60% in price year over year, why have you seen such, inflation persisting when it comes to food and rent? You've got this new data from AARP finding rising prices are causing many older Americans to delay retirement. With the threat of layoffs looming, they're increasingly looking to gig works to make ends meet. Bill, I know Walmart announced it's going to raise wages for U.S. hourly workers to at least $14 an hour next month, but that's not even enough for many who are dealing with this persistent food inflation. What do you think's behind it?
Well, I know it's crazy, and if you look at it on a 2-year stack basis, it's like 20 or 22%. And the things that consumers need, the thing that the American people really focus on, are food prices, lodging, rent prices, and fuel prices, and those three things are really hammering them. It's largely the component parts of it. The food business is supply chain related, and we went through all the supply chain issues that we struggled through in the last 2 years. And then the wage component of it is, we started this press to $15 an hour. As you said, now 15 is not enough. We need 20. And that puts upward pressure on prices. So we're in this spiral, and that has to be interrupted at some point.
You see so much that crosses your desk, Bill, in terms of growth stories within retail. Where is the growth in retail today?
Well, the good retailers, those who are strong financially and from a strategic positioning, are strong and getting stronger, and those who are weak are getting weaker. And you see the struggles of Bed Bath, and you see some of the successes of Walmart because of their food business and Amazon because of their frequency. And so if you look at the big guys who were strong, they're still big and strong, and the ones who were struggling before, they may not make it.
When you say some are stronger, I mean, is there a category that you see continued growth and strength versus sort of stagnation? Can you break down the categories?
Well, I think you got to look at food right now. I think the difference between Walmart and Target is the food business. If you look at that, and I think that's a little bit of what Amazon is sort of muddling through to try to figure out how to get the traffic and the velocity from food. So food retailers, I think right now, provided that they can supply the food and have the supply chain piece sorted out, are one of the areas that I think are very interesting. I think you're seeing a lot of struggles in some of the discretionary areas, like some of the apparel, although some of the really well branded ones, highly branded ones, are doing well. More transactional apparel businesses have been difficult.
Let me get your take on the impact of higher rates. We've got the first Fed meeting of the year kicking off today. This two-day meeting is expected to end with another rate hike. Bill, do you buy into this market expectation that it'll be a quarter point? And what kind of a lag effect are you expecting from this string of rate hikes?
Well, I think we're seeing inflation, the articles say ease. Really, the rate of growth has slowed, but it's still too high. And so, I think the Fed, speculating, will probably go to a quarter point, but it probably need to really keep their eye on it and continue on until we get inflation headed in the right direction, down to the levels that we need it to be at. And really, if you look, you really got to get the interest rate above the rate of inflation for things to calm down. And I think we're getting close to that. So say a quarter of a point here and keep an eye on it for the next time.
And real quick, Bill, we're just getting the fourth quarter employment cost index breaking right now, hitting the tape. The employment cost index is up 1% versus an estimate of 1.1%. We've been watching this tight labor market, and of course, the ECI is one of the most important measures of the cost of employment. What's your take on the labor market and this tightness? Do you think things are getting better with this employment cost index coming in a little lower than estimated?
Doesn't seem to be, Maria. I think in certain places it is, and in certain segments, obviously tech, they're starting to see layoffs. But the services industry, retail, restaurants, it's still pretty tight, and really not a whole lot of brightness on the horizon. I think as wages go up, there's this transactional cost. The guy down the street's paying a little bit more, so they leave, and that employment friction is actually adding to the tightness. So you need wage rates to stabilize and workers to stay put for a while before you can really gauge it.
All right, we will leave it there. Bill, great to see you. Thanks very much. Bill Simon joining us this morning.